Happy Tuesday, everyone. Rich Swerbinski with the Mortgage Collaborative here once again with the last week in mortgage today, our weekly whirlwind through all the latest in the mortgage industry. Each week, pleased to be joined by one of our lender members as my co-host. And this week, really pleased to have in the co-pilot seat, President of Family First Funding, Gabe Gillen. Gabe, great to see you, bud.
Thanks for having me, Rich.
And everybody will have to excuse my scratchy voice, still ailing from Saturday and Sunday night Guardians games at Progressive Field. So hopefully today's game a little bit easier on the voice as we record live a couple hours before my Indians and Gabe's Yankees face off in game 5 of a pivotal opening round series. Funny how the co-host slot worked out to be on this day.
Hey, you couldn't have written it any better.
Well, let's go ahead and get into it. As always, any questions, comments, thoughts, anything, pump them in the chat or the Q&A, and we will incorporate it into the show. Gabe, as we have most Tuesdays this year, we start with the interest rate climate, not because it's rosy, but because it continues to kind of define at least the broader narrative for residential lending and the housing market. And last week, series of economic data headlined by Wednesday's CPI number, consumer price index, kind of the headline inflation number, a little hotter than expected. Sick of uttering that line this year, a little hotter than expected as it relates to inflation numbers. But alas, here we are once again. And, we saw the market not react great to it. And we're still in this kind of like the crappy headlines we all hate to hear, the highest rates in 20 years. So you have any rays of optimism for us to get the show started outside of that noise?
I find that if you ask 6 different people, you're going to get 6 different estimates of when this is going to turn around, right? Everybody keeps talking about a forward, mid 4s, kind of coupon or rate. I've heard everything from this coming spring to August to the end of next year. It doesn't make much sense. I mean, I think that's what's been pretty consistent is everyone just wonders and says, how can it go much higher, right? And sure enough, a week goes by or a day goes by or, 2 hours go by and all of a sudden you have a big reversal in the bond market. So I'm optimistic, but I think I'm also kind of a realist where July or August is hopefully when, to kind of split the middle rather than go with the too optimistic or too pessimistic view of 2023, that is.
Yeah, it's great points. And I think that the thing that is unique about this climate right now is that, to me, there's just so much fear priced into the mortgage bond market. Like, rates are higher and mortgage bond prices are lower than they really should be, given everything that's going on. And it's like the falling knife thing. It's like when any market is kind of falling, you just get people that are just like, you know what, I'm out. Like, I've lost enough where I don't want to be on the bottom of this. So right now you have so much fear priced into the bond market and the mortgage bond market. People a lot smarter than me I talk to and read, they say, man, if we do start to see a reversal on this inflation data, you could see a very rapid rise in mortgage bond prices, reduction in mortgage rates, just because right now there's a lot of fear and uncertainty priced into the market.
Yeah, I think we've seen that for a while. I mean, I guess we've seen it for a while. I mean, and the servicing values are just, if this is the height or close to the height, right? Why would a servicer be willing to pay much of anything to take this loan on the books for 8 to 12 months, maybe? I mean, shoot, it could be 5 months if it turns out to be March, right? So I think that's something that's also been a pretty big struggle for loan officers, depending on the business model for the mortgage company or the branch model. There's just not that much margin in loans, even government loans. It's much different than we've seen. Forget about how high rates are, but the fact, most salespeople I think can sell the rates if that's what everybody's selling. It's not difficult if that's all that's out there, right? But if there's no margin, then they still have to do the same amount of work. You give worse news and not have as much premium in the loan itself. So it's definitely a tough kind of combination of all those factors, what's going on right now.
It's a great point. There's fear priced into the mortgage bond market, and there's fear priced into the secondary market in the mortgage lending industry right now, right? If it's if it's buyers of agency MBS that, are buying 5.5, 6.5% securities, not willing to pay, to your point, much of a premium margin to lenders for coupons with that handle because of what we talked about, the likelihood that rates are lower before they are higher and the prepay risk associated with that, but all the non-conforming products as well, really not much of a market for that at all right now. But again, those are things that could change pretty quickly. I mean, if we do see a reversal in the inflation data, rally to the mortgage bond market, I mean, if those that are smarter than me are correct and you have a ton of fear priced in the market, you start to see the numbers reverse, see rates drop as quickly as they've risen here these last couple months. Picture the climate with a lot of underlying demand still out there to purchase homes. If we did find ourselves in the mid fours sooner rather than later.
Yeah, absolutely. I mean, then, don't forget about probably $1 trillion plus refinance volume that's going to come back, right? It's going to be a bit of, an operational struggle for a lot of companies that made, tough decisions, but smart decisions, and had to lay off and cut some staff and downsize during this the present, year, right? So it's kind of like this is probably the quickest whipsaw kind of vicious circle that I've seen. And, I haven't been doing this too long, but still, at least in the last 15, 17 years here.
When you see volatility in markets, it presents opportunity. And, I think that the one thing we're also starting to see now is just continued growth in rents. It's starting to slow in some areas, but still at elevated levels. Rents lag, the interest rates and home prices are fluid markets, right? They're constantly moving and are constantly changing. Rents, they move slower because people are locked into 2-year leases, and landlords can't change rents the way that mortgage rates change on a daily basis. So again, people smarter than me, part of the opportunity that lies ahead on the other side of this market is going to be, you're going to have this period where if and when rates do drop, it is going to be dramatically the better option for people to buy if they qualify than to rent, because of that kind of the lag that we see on rents. If landlords will ultimately be forced to lower rents if interest rates and home prices drop, but it's going to take longer and it's going to open up more opportunity in the home purchase market. No?
Yeah, no, absolutely. I mean, I'm probably the worst person to talk to as a residential landlord, because I don't think I've ever raised rent on any of my investment properties. And I should have, and I'm sure I could have, especially when I've read some of the statistics from the last, 3-4 years of how much they've risen. But yeah, no, I mean, if the only option is going to be to, because of demand and because of additional inventory that'll come from lowering of interest rates, the only option is going to be that these landlords are going to have to cut their rent because of competition, or, because of how high these rents are now. If the landlords do not lower their rents, then by all means, why rent if you can own and pay the same or less?
Yeah. And then on the flip side of that, the landlords that own these properties have been very, very well publicized. The spawn institutional investors, right? Historically, 11, 12, 13% historically of all home purchases, non-owner occupied. We've seen that catapult. Last year was high. First quarter of this year was extraordinarily high. I want to say it was damn near 20%. But you could see on the inventory side, the home purchase side, the returning the home purchase market to healthy side. A lot of these landlords that may want to, hey, maybe this is the top, and maybe it's time to sell some of these investment properties that we own.
Yeah, I mean, and hopefully they can work something out with their tenants, so that way they don't lose out on both, right? I think it will be an opportunity for that. I mean, I know that'll help get some new resale inventory out there, right, to the public as well. It's going to be interesting to see, that's for sure, because everything is really contingent on that inflation number, right? And everybody's just kind of sitting, watching, and waiting. Every time they come out, or every time there's any kind of economic indicator released, I almost stop even guessing what's going to happen, right? Because I think I've been wrong. I mean, I've been wrong more than I've been right, But there hasn't been a ton of logic in some of the things that have happened, right? Or there's been competing economic data that you would think would have driven it differently. And then here we are at the end of 8:30 in the morning, and we get the announcement, and I just shut down one of my websites. I have my Google Chrome websites, which was an MBS, rate alert. I don't know if you heard that in the background, right? So those were good noises. Those were bells that meant there was a reprice for the better, right? So that's what you hope for when you get these 8:30 announcements on any Tuesday or Wednesday morning.
Absolutely. I remember saying at the beginning of the year, we're going to see 3%, we're going to see 7% this year. I somehow ended up being right. I feel like this is the top. I really, really do. I feel like there's so much fear and loathing priced into the bond market right now that just anything that is even somewhat anti-inflationary, even somewhat anti-consumer spending, because that's been a big part of it too. It has been amazing, the American consumer, how they have just continued to spend money in the face of this inflation. It's befuddling the brightest economic minds in the world, how Americans are just drunken spending still in the face of record inflation, really.
Yeah, no, you're absolutely right. You're absolutely right.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the president of Family First Funding, Gabe Gillen. And any questions, comments anybody has, go ahead and throw them in the chat, the Q&A. We'll incorporate them into the show. Gabe, sticking with the positive train of thinking here, we had the show I do with Rob Krisman on Friday. We had the FHA Commissioner, Julia Gordon, on this past Friday. She was phenomenal, was great, and answered a tons of questions, and, didn't come out and say 100% for sure FHA MIP reduction is coming, but basically said it's highly likely. We're just trying to figure it out, and it's tied in with the 23 budget. So again, something positive that we have coming in the horizon, something that a lot of leaders in our industry have called for some time now, with the reserve fund at healthy levels, delinquency is still low. So something I'm sure that leaders like yourself are looking forward to. Every little bit helps, right?
Yeah, absolutely. So I'll talk about that a couple of different points on that. I've been saying to my sales staff that I expected that to happen since probably fourth quarter last year, right? And it's just a matter of time. It's not if, it's just when, right? And I saw that it's announced that it's going to come out with the 2023 budget, right? Announcement. But I Googled and searched and scoured and even tried to see when the 2022 budget came out, just to kind of get a date there. Did she share that with you? Because I was traveling on Friday, so I didn't hear that. I didn't tune in.
I don't think their budget, they're a government organization, so you got to be able to find it somewhere. They're not, I have not seen any headlines or news releases ever on FHA's budget. So I'm just assuming around the end of the year. I don't know.
Yeah, no, I mean, I lost about 10 minutes of my life, and I'm pretty good with Google, but for whatever reason, I couldn't find it. But yeah, and so the second part of that is that, yes, I think when that change, when the MIP changes, or whether it's the upfront life alone, whether it's the monthly, those changes typically spawn another mini little refi boom, right? At least to streamline, opportunities and such. But a big part of getting a streamline to work is a lender credit, right? To give that lender credit to the borrower so that their costs are covered, or so that some of what they have to bring to the table, or avoiding an appraisal can occur, right? If there's no premium in servicing values, if there's no yield spread, no service release premium, right? It's going to limit that as well. So that's kind of my new thought is, wow, this is great if and when it happens, and it should happen based off of all this data and where their MIP fund is at, their reserve fund. But when it does, can we help that many people, or is this going to really help more existing FHA clients? Can we help them, or is this going to be more used for new first-time home buyers, right? So I think if both of those things can kind of both happen early next year, then great. Then it could be a perfect storm for saving a lot of people a lot of money and really putting them in a better financial position than they've been in for a while. Even if it's not today, but getting rid of that life of loan mortgage insurance is significant.
Yeah, it's a good thing, but to your point, it is a demand catalyst, right? In a market where we have much more demand than supply. So to your very astute point, like, hopefully this is dovetails with some help on the inventory side of things. Because yeah, I mean, even this year, I mean, there's been talks of first time home buyer tax or things they've done in the past to help spur the housing market, but we have a supply issue right now. And a lot of people have said, listen, we shouldn't do anything to stoke demand right now when you got this kind of market. But the FHA thing, to your point, it's way overdue. I remember as well talking on this show a year ago, before, like, it's got to be coming, right? Q1
Could be tomorrow, could be next month, right? And I stopped saying it because it was just I was wrong.
One of the other things Julia talked about is they have a comment period open right now for lenders to opine just on low balance loans in general, which this has been a big sticking topic for me forever. I remember working for running lending for a bank and the high cost lending limits. And we were like right in the city of Cleveland. We were doing a lot of low loan amount, affordable lending. And, the caps on fees as a percentage of loan amount to not trigger like high cost lending stuff. And you get like $30,000-$40,000 loan. Like, I remember losing money to make those deals. We hear all the time our members talk about the same with like the state bond programs. Like, these are programs that are designed to help people, that are great programs, yet you're almost disincenting the lenders to do the deals because they're difficult and you can make no money on them. So I could just tell by the way she was talking, like, they are aware of that. And, I think they want to do everything they can to help encourage lenders to make loans to everybody. So it was promising. This administration in general, forget about the politics, just the housing leaders. Yeah. It is refreshing that they want to talk to lenders and they want to have their ear to the ground, because we haven't always had that.
Yeah, no, I agree. I mean, I'm a part of a few associations as well that really drives and kind of lobbies for the industry, right? For the industry as a whole, but not just the depositories, but also the IMBs out there. And there's been a lot more reception this year. I mean, it has felt like that for at least this year, last year and a half. And so, yeah, so it's positive, and I guess we can all be optimistic that that some of these things don't just sound good, but they'll actually come out and we'll get some nice results as a result of it. And really, at the end of the day, most of these programs are to help the people that to help people that the program was established for, right? So low to moderate income, first time home buyers, minorities, and if it's not serving the public in that sense, then it's really not fit. It's not fitting its mission either. So it is very important that, they heed the advice of the industry to make some changes that can, really make a dramatic effect on helping people, achieve a home ownership.
Very well said. Some good stuff in the chat and the Q&A from our good friend Bob Niemi. I know some people buying the inflation cycle out of fears that next year the same item could cost them twice as much. It's a thought to consider. I think that's what we're seeing now. Consumer spending has to calm down. I know we're going into the holidays and all that, but just it feels like the Fed right now is dying for consumer spending to wane. And quite frankly, they're dying for higher unemployment as well. All stuff that would, ease a little of the heat, the inflationary heat. So yeah, it's a good, smart comment by Bob. I think that's part of what's going on right now.
No, it absolutely is. And I see somebody put something in the Q&A. Let's see. It's Brian. Brian.
Oh, about the EPOs, yeah, because that's if my scenario plays out where we go, you got fear and loathing baked into the market. We get positive inflation data. You get a big rally in the mortgage bond market, and we're say 5% even. I mean, know your EPO, your early payoff policies. If you're a mortgage lender right now, just in this climate where a lot of the purchase loans that you're doing right now or refis could be refis 4 or 5 months from now.
Yeah, I mean, so that was kind of a lesson learned, from the COVID years, right? From the last 2 years, I think, because we had every company, the industry as a whole, had just a ton of EPOs that came back. I'm not talking about even, repurchase and loan defect stuff that we're seeing now from that same period of time, but the EPOs were so prevalent because rates dropped very quickly and everyone was refinancing, right? And I think lenders had to learn lessons from that if they didn't already have some policies and some structure in place where, We now have triggers and analytics that tell us when these periods end, and analytics that check the system to make sure a new loan isn't disclosed prior to a certain date for that same borrower on that same property, just because it can cost lots and lots of money, and it can be a big loss for the company. And then depending on your contracts, your loan officers, you're going to try to fight and take that money back from a loan officer in this market where everyone's recruiting. The bigger companies are recruiting every day. It's tough. So you have to have some controls in place to make sure, especially this time around. If you didn't have them last time around, it's really important to put that stuff together, I would say, now. And let's hope for a March FHA MIP reduction and a 4% coupon.
From your lips to God's ears, or whoever everybody's listening to is praying to in this cycle. So this is the last week of Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by Family First Funding CEO Gabe Gillen. Gabe, Equifax made some news this week. Good news. We've had some bad Equifax news releases over the course of the last couple of years, but this one was just along the lines of, we've talked a lot about alternative credit. Another thing that FHFA just did, and FHA starting to consider rental history. Why not? It's the biggest payment for a lot of people. If you're making it on time, it should be relevant, right? Just because not in the credit report. Common sense lending. And Equifax came out today and said that they're now going to start to deliver utility bill payments with their regular mortgage credit reports. Before we go out and praise Equifax for, some innovative move here, this is something they've always done, really used to charge for. And I think just the win, maybe some of the bad press that they've caught in the past, combined with the push for affordable home ownership and alternative credit, and FICO is not everything. It was good to see Equifax did this. As we talked about throughout the show, every little bit helps, and this helps.
Yeah, absolutely. I had heard previously, Experian had some kind of a boost thing that you could do as well. Like, a consumer could go on to Experian and do something and actually kind of manually push it. Push some of those bills, but I don't know that the agencies accepted those results. It might have been more for consumer use, but yeah, no, I mean, every little bit helps. Every little bit helps, and quite honestly, like you said, rent, cell phone bills, utility bills, those are likely the most, the probably the bills that are paid on time. So hopefully that will help, or it'll give some additional positive trade lines to the consumers as well. I always say, the mortgage may not get paid first, probably the car, probably the cell phone bill, the cable or the internet TV bill, because those are things you can't live without. But the mortgage, somehow there's a way to figure that part out. But the things that those key things, like driving to work, right, and having your toys, I feel like that's part of, I think, why consumer spending keeps happening, right, and why we're so shocked. But maybe we shouldn't be so shocked with how all of Americans kind of spend. But having that data added to the credit report definitely will. I can't imagine it's going to hurt the vast majority of people.
Yeah, it would be interesting to, we look and we see in our industry, like the mortgage delinquency data. It's something that, we constantly hear and see and talk about. It would be interesting to see the delinquency stats on car loans. My guess, the phone bill may be the most paid bill.
Yeah, well, I think phone and car, right? I think because you can't work without, or most people can't. Well, I guess now, you know what? I correct myself. Maybe prior to COVID, the car would have been, right, but now with everybody working from home, people may have sold their cars, right? Maybe they bought a bike or like an electric scooter or something, just to get around town. But I think you're probably right. Probably cell phone.
I live with 4 teenagers, so it's that my brain, I may be totally off. It's but so wrapping things up here, Gabe, so here we are. We just entered Q4 of what has been a tougher than expected year, after 2 much better than expected years. And there's been a lot of movement in the market, a lot of M&A, as you alluded to, lenders with a lot of time to really examine their business model and tighten the screws and think about the model of the future and do all the little things that good lenders like Family First do in these types of markets to gain market share on the other side. So just would love to hear your broad perspective as we get into the fourth quarter of the year. Just, you know, the way as a leader and a CEO of a really well established mortgage company, where your mind is at right now as a leader for our audience.
Yeah, so I really think that lenders in general have their IMBs. So I'm not going to talk about depositories necessarily, but they really have had three choices this year. One of them was to downsize and just get it down to as small and as thin as you can, you know, and just kind of weather the storm, right? There's also a lot of merger and acquisition activity, and that was an option. I think that that's probably slowed down for the most part. You know, if someone was going to sell their company, they probably should have done it, you know, 9 to 18 months ago when the outlook was a little bit better. But otherwise, I think the third option is really just to double down and invest in your company, right? And invest in your growth, and invest in efficiencies. And that's kind of the path we're taking, right? Our path that we're taking is to try to grow into other markets. You know, maybe there's markets where margins for the corporate margins can be a little bit higher, just because of competition or because of you know, saturation of competitors, and also kind of tweaking, you know, the model, whether it be a branch model or a corporate model, but really just trying to find strong individual salespeople as well that we can really build around, or that we can add and plug into some of our sales teams that have been really struggling a little bit. You know, volume's down, so every extra loan helps the branch or the team or the office. So that's really what our focus has been. Our focus has been finding and identifying areas where we can expand, finding the right people. You know, not rushing to take on somebody else's problem. Meaning, you know, if a sales team is losing our competitor money, you know, we want to be very cautious. And I would recommend that any mortgage lender, you know, be cautious. You know, do your due diligence more so now than ever, just to make sure that you're not just saving somebody else, you know, one of your competitors from something that's actually hurting them right now, right? So it is difficult. It's always been difficult to get an honest review or recommendation, right? You're trying to bring a salesperson or even an operation person from, you know, who's willing to be recruited or willing to entertain offers. So now, some more than ever, I think, thanks to a lot of technology, a lot of vendors that have identified this as an opportunity for them to compile this data and to be able to present some of this data, you know, we can make better decisions as an industry, as business owners, and as, you know, the recruiting departments within any entity that's out there. So, yeah, I think it's going to be a cool winter, at least in where you and I both live, and you know, for different reasons. But I think that anybody who can weather this storm and, you know, work on some efficiencies, you know, work on creating things that can save either the customer, improve the customer experience, save some days or time off the life cycle of the loan process, and or make, you know, you be able to handle more volume without having to add additional staff. I think those are really the focuses that really everyone's been working on for the last 3-4 years. But if you haven't finished those, you know, that's something that I think is really important right now. And that's something that we're doing too, is we're finishing up a couple projects that we probably started in, you know, Q4 of 19. And, you know, last 3 years are a bit of a blur as to why isn't that done yet? You know, let's refocus that, or maybe there's something better today, you know, and really just staying aware of what's available, you know, being speaking with your peers as well, see what they're doing. And I think those that remain standing when we fast forward 6 months from now, I think those people have a greater appreciation for what the last 3 years have looked like. And I think you know, the ones that share values and that understand that there's a huge multi-trillion-dollar market out there, and that, yeah, we can compete on a local level, but there's tons of business. You know, I think those that share ideas are really setting themselves up with other businesses to go and continue to grow and survive the next turbulent time we run into.
Incredibly well said. Some words of wisdom for our audience as we take you into the end of the show. And Gabe, really appreciate you coming on and co-hosting this week. Good to see you. Good to get caught up.
Yeah, absolutely.
I'd say good luck to your Yankees, but I'd just be lying. So
yeah, I was going to say go Yankees, but I don't want you to not invite me back for a couple of years.
And to our audience, thanks as always for taking 30 minutes of your week out with us. So we're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. Those of you that listen on podcasts, or the majority of you listen, join our live broadcast every Tuesday at 2. You go to mortgagecollaborative.com and find it on our event calendar there. So until next Tuesday, have a great rest of the week, everyone. Take care, Gabe.
Good. Thanks, Rich. I'll text you around 8 Eastern.
All right.
Right? All right,
Have a good one. Take care.
Take care.